All right, can you hear me on Zoom? All right, great, thank you. All right, let's get started. So let me remind you of the homework that we have out right now. So it's homework 4, and I have a Wednesday due date. That depends on if we get through the material today through the whole chapter. Otherwise, I'll push it off. So we'll see how far we get. But that's it right now. And I thought I would start off with a problem to bring us back up to speed from last time. So we saw put call parity. We also saw the arbitrage argument. I think that was a little bit detailed. So I wanted to start off with a problem, and let's let all of us work on that and run through that to make sure that we have it. So here's my problem. Okay, so assume the stock is at $50. All right, and then there's a put. The put premium is $2, strike price is 45, and time to expiration is 2 months. The risk-free rate is, that's supposed to be a 3. Let me write that a little clearer. The risk-free rate is 3%. By put call parity, what is the price of a call? And what I didn't say here was same strike and expiration. So first I'm going to let you try to work on this. Do you have your notes? Do you remember put call parity? First, see if you can do put call parity. If you just calculate what would be, according to put call parity, the fair price of the call. Yeah, I can jump over to the or you know what? I will write the formula right down below. So here is, let's put it in parentheses. Put call parity. Does anybody remember what it is? So yeah, long a call. I always think of it in terms of the portfolio. Long a call, short a put. Can you see that in your mind? You can see it in your mind. That's really good. Long a call, short a put. They're at the same strike. That gives you the straight line, but it's too low. So you need to push it up by X, and then we end up with discounting 1 plus R to the T, and that's equal to the stock price. Okay, so that's put call parity. So let me let you work on that. I think that should be pretty quick, but solve for C0. And then what I think was a little more complicated was if the market doesn't line up with put call parity, how do you arbitrage off of that? So then we'll do that. We'll do that in a second. So maybe I should call this part A, because then I'll do a part B. I'm going to trust you guys for the numbers because I don't have the numbers in front of me. Calculations. I'm going to begin to write down the answer here, but let me know when you have a number on that. So what we want to do is we just want to solve for C0, the call premium. So here's my answer. Solve for C0. So if I do this, C0 is going to be P0 minus X over 1 plus R to the T plus S0. Did everybody do this? And then did somebody plug in for this? So put premium is 2 minus the strike price is 45 over 1.033% was the interest rate. So that's why that goes in there. T is always measured in years, 2 months. So that's going to be 2/12. Is that too small to read? So it's 1/6 of a year plus stock price is equal to, did anybody get the answer? Somebody had to have done this, right? What was it? 457? That doesn't sound right. Is that right? 7.26. I don't know if that's right either. I don't know the number, but are you guys going to make me do it? What? This is just plugging in. 2 minus, come on. If there are two that agree, then I'll go with that. So maybe the 7 looks a little closer. What did you get? 7.083. What was yours? 7.26. Now they're all different. 7.22. Now we have 4 different. Okay. Okay. So it should be just 2 minus 45 over 1.3 to the 1/6 plus 50. Let me see if I can remember that. Oh boy, now Excel is going to take forever to start up. Come on. Okay, so what do we have? We have 2 minus 45 over 1.03 to the 1/6 plus 50. 7.22. 7.22. Okay. All right. I should have had it written down, but okay, 7.22. Okay, so there we go. So put call parity. Put call parity says that should be the price of the call. Now let's go on to the second part, and maybe this was a little trickier. So let's assume the market price of the call is, let's take it to be $8. And I'm going to put an M up here to indicate that's the market price. Let's take it to be $8. Okay. How can you arbitrage? And let me remind you, so we can go over this one together. Or if you want to think about it for a second, that's fine too. But let me give you the basic idea. So here was our put call parity formula. Every time you look at put call parity tells you how to replicate something. Okay. So in this case, put call parity is telling us how to replicate a call. Okay, so put call parity says, how do you replicate a call? Look on the right-hand side here. I buy a put. Why is it buy a put? Because the coefficient is positive. I short a bond. This one here represents the bond. That's why we're discounting it at the risk-free rate. By the way, when I say bond, I'm just sort of generically using that as a term for a risk-free asset. So, and what do I mean by you short a bond? You borrow money. That's all it means. So you would be borrowing money. So you short a bond, and then what do? You buy a stock. Okay. So that's what put call parity is, a recipe for replicating or creating synthetic options. Okay. This case, I'm creating a synthetic call with a put, a bond, and a stock. Okay. So that's the way you should read it. And put call parity says I can synthetically create a call for how much? $7.22. Okay, that's what it's telling me. Synthetically, I want to create a call. It's going to cost you $7.22. This says I go look in the market. If I just want to straight out buy a call, how much is it going to cost? $8. There's a mispricing. How do I take advantage of this mispricing? What's my arbitrage strategy? Yep. So we're going to do. So we're going to buy what is cheap. What we always do. What is that? What's cheap? The call in the market or the synthetic call that I can create with put call parity? The synthetic. Buy what is cheap. Synthetic call costs $7.22. How do I buy this synthetic call? How do I create it? Again, I look at put call parity. So what am I going to do? I'm going to buy a put. What am I going to do next? What's the next term? Yep. Short a bond. Again, that sounds kind of funny. Shorting a bond, you're just borrowing money. Okay, so maybe I should say borrow money, but short a bond, face value. Remember, the face value corresponded to the strike. Face value, x equals 45. And then the last term. Yep. Buy the stock. Okay. That creates the synthetic call. So I do that. That's going to cost me $7.22. That is exactly equivalent to a call in the sense that it has the exact same payoff as a call. All right. So that's buy what's cheap. Sell what is expensive. Okay. Sell a call for Okay, so this is my arbitrage strategy. I'm going to do this. And I'm going to sell the call. So I buy the synthetic call and I sell a real call. How much do I make? My profit is going to be the difference. So minus the cost of the synthetic. So that's $8 minus $7.22. Right. So I'm going to make 88 cents. That's not 88 cents, 78 cents. All right, I was trying to cheat there. There we go. Okay, so you guys okay with the idea here? Put call parity. This is a very nice idea. The idea is that you can synthetically create your own options. That's basically what it says. Put call parity says, if nobody's even offering an option, you can create your own as long as you have, you know, a put, the underlying stock, and you have access to borrowing or loaning money. Okay, everybody good with that? Yes. Yeah, it's not a hypothetical. You can actually do it, but it is the actual. It's the actual minus the synthetic. I'm calling it a synthetic. You create it, but put call parity says, hey, you know what? A call is actually equivalent to this portfolio. They're the same. So you can synthetically, I'm calling it synthetically. I don't know if there's another good word for it, but you can synthetically create a call. If you synthetically create it, it's only going to cost you $7.22. If you buy it from the market, it's going to cost you $8. How can I arbitrage off of that? Well, I'm going to synthetically create it for $7.22, and then I'm going to actually just go sell it in the market for $8, and I'm going to pick up that 78 cents difference. So that's the arbitrage. All right, everybody okay with that? Yep. All right, which one were we on here? What we're going to go to next is, I think we're going to bring dividends into the picture, and then we can do some with dividends in the picture. How's that? So it's not complicated enough. Okay. But if you could do that example, then hopefully you have the idea, right? Put call parity. Look at what put call parity says, you know, isolate one variable, and the other side is a portfolio that replicates it, a portfolio that synthetically creates it. Okay, so I think, let me make sure where we were. So hopefully that was bringing us back up to speed on put call parity. All right, so now let's dive into something that we haven't dealt with so far, and that's dividends. So let's deal with dividends. Okay, to this point, most of the time I've been saying, oh, assume it's a non-dividend paying stock, or we just haven't had a dividend in the picture. Let me show you how to deal with dividends. You might think, oh boy, that's going to complicate everything. We're going to see that it's pretty simple. Okay, it's actually going to be very simple, which is nice because dividends. Yes. I thought I did. Did anybody else see the notes from last class? Anybody else? Maybe nobody looks at them if they take their own notes. I thought I did. I might have missed that, but I thought I did. We're back in chapter 3. All right, let me tell you the main idea behind dividends. And focus on the main idea, because if you have this main big picture, then dividends are really easy to deal with. Okay, so let me try to give you the story behind this. And I'll write it out. So when we talk, about payoff, So I've often talked about payoff. We define the payoff function. And I also talk about price. Okay. What do we mean? We mean a situation where cash flows, I'm going back to the cash flow diagram, are either at time 0 or time capital T. Okay. And so time 0, any cash flow at time 0, we basically called that our price. And any cash flow at time T, we called that our payoff, the payoff function. So if you remember that, here's the picture that I always draw. This is a cash flow diagram. This is time. We're sitting here at capital T. Something occurs at capital T. This is what was our payoff. And then we had something happening at time 0, and this was our price. Right? So that was our picture. You pay a price up front, you wait, it expires, you get a payoff. All right. So the basic question of dividends is, how do I handle an intermediate cash flow? Okay. So how do we handle an intermediate cash flow? That's what a dividend is. So let me show you the picture. So the picture is then this. So there's a capital T, right? Which again, we called that our payoff. There's a price. So let's assume I buy a stock, at some price, and then some little t here, what happens? It pays a dividend. Call that d sub little t. So now our cash flow stream looks like this. All right, and now you think, oh, okay, that made everything messy, right? So how do I handle that intermediate cash flow? I'm going to not allow intermediate cash flows. How do I not allow intermediate cash flows? What I'm going to do is I'm going to actually take this cash flow and I'm going to move it back to time 0. And how do we move cash flows? Now, a dividend is a known amount that you're going to get. How do I move a known amount? How do I pull it back to time 0? I calculate the present value. Okay, so that's what I'm going to do. So we will move intermediate cash flows either to time 0, okay? And when I do that, then I'm going to consider them just to be part of the price, or they will become part of the price, right? Or to expiration T. Or they become the payoff. They become at least part of the payoff. Okay, and in fact, the one that we're going to do more often is we're going to do this one. When you have a dividend, what are we going to do? I'm going to take that dividend, which is an intermediate cash flow, and I'm just going to pull it back to time 0 and say, you know what, that's part of the price. So let me show you the full picture here. So I start out with this. I've got a payoff at time capital T. I've got a price here, and maybe my price is sitting there, and then I get this dividend at little t. I don't like that sitting in the middle. So what am I going to do with this? We just said we're going to pull it back to time zero. Okay, when I pull it back to time zero, I've got to use the rules of finance. What are the rules of finance? The rules of finance say when I pull it back to time zero, I need to calculate its present value. Okay, so that's going to be dt over what? 1 plus r to the little t. That's just the present value of that. So I'm going to pull it back to time zero. So that allows me to get rid of this. But now I have my new price. So here's my new price is equal to price, that was this one right here, minus the present value of this dividend, right? So there you go. And then I act as if there was no dividend. Now my price is not the original price, but it's the price minus the present value of the dividend. Okay, let me give you an analogy for this. An analogy, I think, makes this a lot easier to understand. It makes a lot of sense. And then we're going to see how it makes everything very, very easy if I think in these terms. All right. If you go buy something at the store, and maybe it costs $50. So you pay $50, but then there's a rebate. Okay. And I don't know if you've ever had it. Some of the time you have to fill something out to get the rebate, and you got to send it in, and they're going to send you the rebate, and maybe you get it in a month or two. Okay. That's like the dividend. The dividend is like a rebate. So you buy the stock, but then in a month or two, whenever they pay the dividend, they're going to pay you a rebate. That's like the rebate. So when you go and buy it at the store, you say $50, but oh, there's a $10 rebate. I'm going to get that $10 back. What do you say? Well, how much did you pay for that? What was your overall price? You take the price and then you're going to subtract off the rebate, right? Now, if we're being careful in our finance sense, we should really subtract off what? The present value of the rebate, right? If we were being careful. And that's all this says. This says, hey, you got a stock with a dividend. Dividends are rebates. So your net price is just the price you paid minus the present value of the dividend. Does that make sense? So if I do that, then handling dividends is no problem at all. Dividends, I just subtract them off the price. All right, let's see how easy that allows us to handle dividends. And this is always going to be our philosophy with dividends or intermediate cash flows. Just pull them back to time zero. Think of them as a rebate. All right. So anyway, this is my comment. Think of a dividend as a rebate to the price. That's the right way to think about it. Okay, so now that we have this, let's go back. Let's revisit put call parity. But now we can add dividends in, and we'll see there's no issue at all. So let's do put call parity with dividends. Let's highlight this. This is a new section there. All right, so here's the idea. So let's do just like we did before. We're going to match payoffs. What was our picture before? I'm going to go through this kind of quickly, but hopefully you remember this. We have a strike price. What did we say? We said long a call. Does everybody remember how we got to put call parity? Long a call, short a put. Right? So that went down. And then what did we do? Add a bond equaled the stock. So this was the stock. This was the payoff of the stock. This was the payoff of the call. This was the green was the payoff of the put. And then we also had, I need another color in here, but we also had this raising it up, right, was the bond. Does everybody remember that? Same thing applies here. Same thing, exact same formula applies. So I look at payoffs and I have the same formula. Remember the payoff said long a call payoff, short a put payoff, push it up by X, the strike price. And that is exactly the same as a share of stock, okay? Then what did we do? We said two things that have the same payoff must have the same price. So now I go and I just price both sides of this equation. How much does the call cost? Well, that's the call premium. How much does the put cost? Well, that's the put premium. How much does the bond that pays off face value X cost? Well, I need to calculate its present value. Everybody remember that? And now I go to the other side. How much does the stock cost? Ah, but the stock pays a dividend. So now I need to use the notion that that dividend is like a rebate. What is my effective price for the stock? Well, it's the stock price minus the present value of any dividends. Got it? Because those dividends are just a rebate off the price. So my net price for the stock, for the share of stock, is just the stock price minus the present value of any dividends. Now we're done. No, yeah, you've got to be given the dividend amount, right? And when the dividend occurs, because we have to discount it back to time zero. So you need to know exactly when it occurs. So see how easy that is? So this is put call parity. With dividends. All right, let's put some stars by this. Let's do an example. But isn't that easy? If you thought dividends are going to make they're going to mess everything up. How do I deal with dividends? No, no, no. Dividends are just a rebate to the price. You subtract them off. And then we're careful finance people, so we need to subtract off the present value. But that's it. All right, so let's do an example here. In my notes, for some reason, I had this as example 2. I'm not sure why it's a 2, but I'll leave it as a 2 here. Oh, because I said consider example 1. I got to remember what example 1 was. We'll go look back at example 1. Consider example 1, but now assume the stock not with, stock will pay a dividend of, let's say, 50 cents in 1 month. Okay. I guess I got to go look back at example 1, but I have all the numbers down here. So recall, I guess from example 1, we had S0 is equal to 40. That is, the stock price is currently 40. The risk-free rate was 8%. Time to expiration was 3 months. What else did we have? We had the call price. Call premium was $2.78. And strike price, it was at the money. Strike price was 40. Okay. And then question, what is the put price? Okay. So easy. All I need to do here is I just need to do put call parity. But now I need to take account of the dividend. Remember, the dividend is easy. That's just a rebate to the stock price. So let's do that. So let's go to our answer. Answer, use put call parity. Okay, and so put call parity, C0 minus P0 plus, let me just write it down again, 1 plus R to the T equals, but now I do S0 minus the present value of any dividends. And the dividends have to occur prior to expiration, right? So I'm gonna solve this. I'm gonna rearrange this. I like to rearrange the equation first and then substitute everything in. So I'm gonna get C0 minus S0 minus the present value of the dividends. I don't want to write the full word dividends, so I'm going to write div plus X over 1 plus R with a capital T. So there we go. Now I need to plug in numbers. I like to rearrange first. So C0 is $2.78 minus this part in here. This is just my stock price with the rebate, right? That's why it's S0 minus that rebate that I got from the dividends. So let's put that in. Stock price was $40 minus the present value of the dividend. Now I need to look at the dividend more carefully. The dividend was 50 cents. And I need to calculate its present value. So I'm going to do 1 plus the interest rate. And then when did the dividend occur? It occurred after 1 month. So I need to discount it back by 1 month, or that's a 1/12 of a year. Everybody okay with that? I'm just calculating the present value of that dividend. That's the part in parentheses there. Plus, I have this 40 over 1.08. And now this one, the strike price refers to the expiration date. Expiration date was 3 months, or that's a 1/4 of a year. So there you go. Crunch through all of that. And I hope I have the right number here, $2.51. Anybody's really quick on their calculator, they can confirm that. All right, so that's how we handle dividends. Very, very easy. We just subtract dividends off of the stock price. They're like a rebate. Okay, and then all the same arguments. Now, I won't do like an arbitrage example, but the same arguments with arbitrage work here as well. Okay, so again, we can say a synthetic put is a call short a share of the stock long the bond. That still creates a synthetic call in this case. All right, everybody good with that? So put call parity, that's like, that's the big result of this chapter. And then we're gonna have one more result, which is very important to be aware of. We're gonna go through a couple of lower bounds and stuff like that. And I'm gonna prove one final thing that everybody should know before you start trading options, and we'll get the results out of this. All right, so that's put call parity. Let's move on. We're going to see that we can use put call parity to derive some other things. So it's going to give us what we call lower bounds on the values of options. So let's go to that. Put pricing. Lower bound. And I'm going to jump back to the non-dividend paying stock case. That's where we get a nice formula. So let's underline that so you don't get caught by that. I'm back now, jumping to that non-dividend stock paying case. All right, so here's the idea. So put call parity can be used to derive pricing bounds. Here's the first pricing bound, okay? So it says the value of a put must be greater than or equal to the maximum of the following two things: 0 or the strike price discounted minus the stock price. Let's highlight this. Let's put a star by this. Okay, so what this tells us, what does this look like? This looks very, so if I look at this carefully, I say the max of 0, I've got X here, I have it discounted, but if it wasn't discounted, if I didn't have that divide by 1 plus R to the T, then I would have X minus the current price of the stock. That would look like the payoff function. So that would say that the value of a put, what this is saying is that the value of put is always greater than or equal to something that's actually very close to the payoff function. Okay, now in this case, it can actually be lower than the payoff function. Let me show you where this comes from. And then when we go to the call side of this, we're going to see the call side leads to a very, very important result. But we're doing the put side first. So let's prove this. Prove using put call parity. We'll just see where it comes from. That's what I mean by a proof here. Okay, so let's start with put call parity. So by put call parity, what do we have? We have C0 minus P0 plus X over 1 plus R to the T. You'll see how easy this is. Easy put call parity makes this. All right, and then what am I going to do? I'm going to solve for the put price. So P0 is equal to, I solve for the put price, and I'm going to write it, I want to write it in the right order. So I get this by put call parity, right? But the value of a call is always positive, right? So this is greater than or equal to, if I just drop the value of this call, and there you go, I essentially have the result. So this right here is half of the result, right? So this says the value of a put must always be greater than or equal to its strike price discounted minus the stock price. Again, that's very close to what we see in the payoff function. We also know that the value of a put is always positive, right? Put is always valuable. It's never going to have a negative price. It's always positive. And so if you combine these two together, so combine this one here, combine to get the result. And what was our result? Our result was that, look, a put is always greater than or equal to either 0, that's because we know a put will always be worth something, or in worst case, it's worth nothing, or this quantity here, that's what this was over here. Okay. Did I do some examples on this one? I didn't have some examples on this one, but if you have the formula and they ask you, they don't tell you now what the call is worth. They just tell you a put. What is the lowest it could ever be worth? You calculate this formula and it tells you, oh, the put is never going to be worth less than that. Okay, so it's a lower bound. on the value of a put. All right, this one is good, but it's less interesting than the other one that we're going to do now. We're going to go to the call side, and we're going to get a very important result on the call side. All right, so let me flip over to the call pricing lower bound. All right, so again, we're going to start from put call parity, and we're going to do the same argument. Let's start from put call parity. Put call parity says C0 minus P0 plus X over 1 plus R to the T equals S0. And then what am I going to do? I'm going to solve for C0. C0 is equal to S0 minus X over 1 plus R to the T plus P0. Okay, and then the value of a put is always greater than or equal to 0. So this is greater than or equal to S0 minus X over 1 plus R to the T. Okay, so it's the discounted strike. Yes, that's exactly what it is. It's the discounted strike. So here we have our lower bound. A call is always at least worth the current price minus X over 1 plus R to the T, or the discounted strike. Okay, what do we also have? So we also know that a call, price of a call is always going to be positive. You're not going to have a negatively priced call. So combine these, and we're going to get that the value of a call is always greater than or equal to the larger of those two, 0, or S0 minus X over 1 plus R to the T. So here's our lower bound for a call. Again, if I look at this, this almost looks like the payoff function of a call, right? Or actually, when we calculate it using the current price of the stock, if I didn't have the discounting here, this would be the intrinsic value of the call, right? So this is almost saying a call is always worth more than its intrinsic value. Remember, its intrinsic value was its exercise price. Okay, let me do an example, and then I'll get to the result that I keep on previewing, saying that's really important that follows from this. So let's do an example just with some calculations. Let's do the call lower bound. So let's choose some numbers. Let's say you're looking at a stock, its price is 28. You're looking at a call with strike price 25. Risk-free rate is 5%, and it expires in, I'll do it in years now, a quarter of a year. Okay. What is the lower bound for a call? So we're just going to use the formula up above. So answer, we're just going to plug into that formula. C0 is greater than or equal to the max of 0. I'm going to plug in the current price of the stock, 28. I'm just using the formula up here, minus the discounted strike, 25 over 1.05. That's the interest rate to the 0.25. I'm going to plug into that. If I do that, let me do it in one more step. Maximum of 0. If you calculate that, let's see, what is this here? I think this is 24.7. That's at least what I have on my notes. So this is 3.3, which is equal to $3.30. So again, what we're doing here is we're beginning to narrow down, like we're beginning to put bounds on how valuable is a call option. Well, it can't be any less valuable than $3.30 here, right? It's got to be at least more valuable than that. All right, let me ask you then a question. And then I'll get to the key result. So here's, I'm going to put it as a note. It's a note. So the lower bound we just calculated was for a European option. Okay. That was for a European option that doesn't pay a dividend. So let me ask, if this were an American option, in particular, this is a call, right? This were an American call. And I exercised it early, right? That's the value of an American option. I can exercise early. How much would I have received? What if let's say this were an American and I exercised it right now. How much would I get by exercising it? It's in the money. Look, 28. The strike price is 25. $3. You said it. There you go. $3. It would be the current price minus the strike price, right? So it's 28. It's just how far into the money it is. It's basically the intrinsic value of this. I would have gotten $3. Okay. So now let's look at this. So if it were an American option and I exercised it, I would have only gotten $3. Our lower bound says that for a European option, not even with the American, the ability to exercise early, but for a European option, it should be worth at least $3.30. So you see that a European option with no ability to exercise early is worth more than if I could exercise that American option right now. So let's just write this observation down, and we'll see what this leads us to. So this early exercise value. This is less than the lower bound that we just calculated for a European call. So this actually leads us to a really important result. Okay, so here's the result. Make sure you remember this result and know it well. Otherwise, you're going to be taken advantage of in the option markets. Okay, So here it is. From our observation above, an American call only for a call option. Doesn't work for a put, only for a call option. An American call on a non-dividend paying stock. We were in the non-dividend case. If you have it on a dividend paying stock, this result does not hold. Only on a non-dividend paying stock. So that's important. An American call on a non-dividend paying stock should underline this, highlight this, never be exercised early. Never, never, never. You have a American call option. That's what most equity options are. American option. You have a call option. You hold it on a stock, and prior to expiration, there's no dividend. Never exercise it early. Never, never, never. Okay, if you exercise it early, you're going to be taken advantage of. You're doing something not smart. Okay. So what should you do instead? Everybody got that? You're saying, but wait a second. I hold this American call option. The stock has gone way up. I think the stock is going to go down. I want to get out. Shouldn't I exercise? No. No. Never. Look, that's the never. Never, 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 never exercise an American option on a non-dividend paying stock. So what should you do then? What should you do? The stock has gone up. You think the stock is going to go down. You're looking at your American option saying, I don't want to hold this anymore. I've already made a lot of money, big in the money. Shouldn't I exercise? No. What are you going to do instead? You're going to sell. You're going to sell it. You're going to sell the call. Never exercise it. If you sell it, what did we just show? We showed, well, I haven't showed it yet, but just from our example here, even a European call option will be more valuable than it will be to exercise it. And yours is an American. Okay, so that's really important that you remember this. This is the only case that this happens. Any other case in the market, you can say, oh yeah, it might be sensible to exercise early. For this case, never exercise early. If you do, somebody's going to take advantage of you. You are exercising it early. You are not getting as much money as you could have gotten out of that option. It would have been worth more for you to just sell it to somebody else. It'll always be worth more in the market than the early exercise value. Okay, has everybody got that? So this is a really important result. If you're trading in option markets, make sure you know this. Never say, oh, I got an American option here, so I can exercise early. If it's a call on a non-dividend paying stock, that early ability to exercise early does you no good, because you will never use it. And anybody who knows their options will never use it. So in fact, the other thing that follows from this is that an American call option on a non-dividend paying stock should be worth exactly the same as a European call option on a non-dividend paying stock. Why is that? Because it will never be exercised early. There's no value in being able to exercise it early because nobody will ever do it. Okay, kind of surprising? Yeah, but you need to know this, right? I said, don't get taken advantage of in option markets. If you go out there and you exercise early, you're doing something. You tell me, you're super far in the money. What are you going to do? You sell it. Never exercise early. Never, never, never. Okay? You can't argue with the theory. You can argue with the theory if you want, but yeah, it's not even about the shares or whatever. It's about, it's worth more to sell it to somebody else. Okay, otherwise you're getting taken advantage of. Okay, you're doing something suboptimal. I'm trying to put it in a nice way, but okay, so that's important to know this and remember this. This is the only case. Needs to be a call option, no dividend. Any other case, there might be a reason that you would exercise it early, but this one, there is never any reason to exercise early. Let's prove this, and then I'll show you sort of in pictures what it corresponds to. The proof is very simple. So if I call this a proof, so this is just a simple argument as to where it comes from. So we're talking here about the value. I'm going to do this. That's an American option. So that's what we have. I've got an American call. I put the A up there because it's an American call. Okay, so the value of an American call is always more than the value of a European, right? Because you can exercise it whenever you want. And in worst case, you just treat it like a European. So an American should always be valued more than a European. Okay, and we just derived a lower bound. This was our lower bound. Our lower bound says the value of a European call is always greater than the following. This was our lower bound formula, right? But then we can note here that this term, the discounted strike, okay, that's actually subtracting off something smaller than the strike. You got to think this through, but this makes it smaller than the strike. So I can actually do another inequality here, saying that that is actually greater than or equal to the max of this. Yeah, think about that a little bit. Now you're subtracting off something larger. Okay, and what is this? This is the early exercise value of the American call. This is how much you get if you exercise an American call early, right? You get the payoff, right? So what does this say? This says we started over here and we started with the value of an American call is always greater than or equal to its early exercise value. What do I associate with this value? This value is how much I can sell it for in the market. That's what I mean by that. That's the price, the premium that you will see for it in the market. That's always more than if you exercise it. And that's what our result is saying. Our result is saying, look, it's always better for you to just sell your American call in the market. That is always a better idea than to exercise it. So that's what we have here. So note another way to think about this down here is this was, what did we call this value? This is the intrinsic value or the exercise value. That was the intrinsic value of the option. Okay, but anyway, that's where this result comes from. Like I said, remember this result. If you exercise an American call early and it's on a non-dividend paying stock, everybody knows you're a naive option trader and they're going to sell you lots of American calls and take advantage of you. Okay, in pictures, let me show you what this corresponds to. So here's sort of a picture to keep in mind. What this result is saying. But look at what else this says, by the way, before I do the picture. This actually says the value of a European call is always greater than or equal to the early exercise value of an American call. Okay. So let's look at this. What this picture says is that if I go back to my payoff diagram, okay, and what I'm plotting here is the payoff function of a call. So this is the payoff function of a call, right? And that's essentially what we have right here. We have the payoff function. Just I'm able to, for an American, I'm able to do that early. So what this says is, if I look down here, here's the stock price. And if I actually do the value of the call, then what does it say? It says the value of a call is always above the payoff value. That's what this result is saying. So the value of the call, people often visualize it as something like this, as the black line, or maybe I should turn it into a green line. That it's always going, the value of a call. So this is the value of my call. This could be my European call. It's always above the payoff value. Okay, so they will visualize it this way. And so when you visualize it this way, this is another reason they like to break down the price of options into intrinsic value and time value. So if I break it down into intrinsic value and time value, then let's say that the stock is sitting at some value right here, then this amount up here is the intrinsic value. And then this amount here is the time value. So anyway, this is sort of an aside, but this is a way to visualize the value of an option. And so this is saying, look, the value of your option is always going to be greater than or equal. If it's a call option, is always greater than or equal to the early exercise value, which is what we call the intrinsic value. So if you look at an option like this, there's going to be an intrinsic value, and then there should be, in the case of call options on a non-dividend paying stock, there should always be positive time value. That's what it's saying. It should always be positive, should always be worth more than the early exercise value. That's what that's saying. Maybe that's a little confusing in the diagram, but it's very common to view the picture like this and break down intrinsic value and time value. All right. I don't have too much time left, and I'm at the end of this chapter, so I'm going to stop here. Remember that the homework is due on Wednesday, so we got through everything in chapter 3. You should be able to do the homework. But sort of the big results, the big takeaways were put call parity. And then this last one here, this is a really important one. Remember this one. Every option trader should know this, that you never, never, ever exercise an American call on a non-dividend paying stock early. Will absolutely be an exam question. Yes, absolutely. Or maybe I'd throw you off and say, but the stock pays a dividend. Then would it ever make sense to exercise early? Then it might. Then it might. So this is the only case, but you absolutely need to know this. All right, next time we're going to move into option pricing theory. So we've been doing our bounds and stuff like that. Then we're going to begin to hit the meat of the theory next. So prepare yourself for that.
Question for you. Can you tell us, I don't know exactly what problem was, but it was very early on in today's lecture. Exactly. I'm not punching in correctly on my calculator. I'm getting a very different answer. It's the one that is like 7.22.
Yeah. Oh, yeah. Let's go to that. Hold on, let me check out a Zoom here.
I'm thinking about investing in one of these one notes over, well, not just to save on paper and stuff like that. How much did you get that one?